Okay, I think we're good for starting. Thank you everyone for joining today. Today we'll have Eric from WilmerHale discussing the challenges on allocating founders' equity. So some of the rights and protections related to founder equity, typical terms and founding agreements, VC expectations, and CD financing concepts. So I think this is going to be a very interesting webinar. And yeah, we have Eric here. I'll pass off to you. Thank you very much for joining us. I appreciate you.
All right, thanks. Thanks for having me today. Good to be speaking with you all, and look forward to our presentation today. So, like I said, I'm like Gabriella said, I'm Eric Hanson. I'm a partner in the corporate practice group at WilmerHale, and I'm going to be talking a little bit about founder equity. Gabriella, can you see my screen?
Yes.
All right, great. So here's the agenda for today. We're gonna go through, how do you decide who is a founder and who is not a founder, and then once you hit that threshold question, how do you allocate? Some of the other key issues that you need to think about as a founder, in your founder agreements, and then also we're sort of going to ramp towards a little bit of discussion at the end on financing considerations. At the end of the day, we set up the founder equity in a structure that we want to meet investor expectations, and so the goal here is to set you up for success, and so we'll talk a little bit about considerations you may want to keep in mind as you go. As I go, I'll do my best to keep an eye on questions. Gabriella may interrupt. Do feel free to send them in the box, and we can address them along the way. All right. So what does it mean to be a founder? A lot of people come to us and they say, is person X a founder or are they not a founder? And how do we decide on who a founder is? And so I think it's worth, before you even think about how you allocate the founder equity, think about who in fact is needs to be a founder for the sake of your company. So you want to think about folks who have sort of mission critical roles. You want to think about who the folks who, if you lose, you don't have a company, and those are the types of people that you would want to have as a founder. You want to be able to have some a few or several conversations as among the founders to sort of decide what the roles are here, and so you want to have some cleanly delineated, okay, there's a technical person, there's a management person, there may be a finance person, but you want to have some sense of who's taking what from the early days. One critical thing to think about at the earliest stages is every founder will be, and every employee will need to assign their intellectual property to the company, and so it's important that as you have those discussions, you want someone who's willing to give their IP to the company as they work for it. If they only want to be part-time, then I don't think of them as a founder. All right, so here's a little graphic that we use that talks about who founders are. By and large, it's your CEO is a founder, your CTO may be a founder. A lot of the other roles that come in later, finance, sales, even an operating officer, those tend to be non-founder roles, and those tend to be backfilled later in the company's lifespan. So why do we talk about equity for founders? Well, I mean, importantly, the founders are going to be paid cash and stock. There's no stock or there's no cash at the front end. And so it's almost always the case that particularly in the early days, your majority of founder compensation is going to be in stock, and the cash will be enough to live on, perhaps with ramen, but you're not gonna get rich on the cash that you make as a founder. So now how do we think about allocating the equity itself? So here's a few sort of baseline assumptions you should think about, and this is sort of the math we go through with clients as we as we uh, talk through, who gets how many shares. So most companies we work with, they start with 10 million shares of authorized common stock. Then out of the 10, we sort of do an assessment of who the founders are, and then divide out roughly 5 to 6 million shares to the initial founders. Then you're going to take another 10 or 20% of the 10 million shares, and you're going to authorize that to an option pool. Really, how much you allocate toward the option pool depends on what you think your near and long-term hiring needs are. If you're going in and on the assumption that you have 2 out of 3 of your critical founders, but you're going to need a critical third founder to complete the founder set, then you may well need to either set aside some shares for that future founder, or have a very large option pool, so that you can make a sizable option grant at the time that additional founder comes in. So I've touched on the next bullet. So you may well decide, okay, we, out of the 10 million authorized, we want 9 million to go out the door on day one, and then 1 million shares are going to be reserved in the pool. That's one approach. But more often, what we do is we will say, okay, 5-6 million shares go out the door on day one. Maybe 1 million shares get reserved, and then that leaves you with some amount of shares, 3 or so million shares that you can use for that third, that critical third founder. And then, importantly, certain industries may well, assume that you're going to have collaboration deals, or you may well have reasons to reserve shares for critical commercial partners, and so you need to keep that in mind as you go. Now, we talked about 10 million shares authorized. That can be changed with the board and a stockholder approval. It's easier to do earlier. It's harder to do later. So just keep that in mind. If you need to make those adjustments, better to make those adjustments sooner. So we've decided we're going to take, out of the 10 million authorized, you're going to take roughly 5, 6, 7, 8, 9 million shares, and you're going to allocate that as among the founders. So often founders come to us and they say, look, we've got 3 co-founders, we're going to split it evenly. We, each of us gets 3 million shares, because that's just the fair thing to do. What we often do at that point is to say to our clients, like, look, okay, take a pause, and let's think about, is everyone's role at the business going to be, both now and in the future, equal, or are there certain folks who are going to be, frankly, more important to the business's future growth profile than others? And how do we equitably adjust for that? And so, you may well have an ideas person who has some initial ideas that they put into the company at the outset. Um, that should be rewarded, but you don't want to, there are a lot of very good ideas, and 99% of the battle for a lot of these startups is not the idea, it's the execution. And so you compensate them for their initial contributions, but you will want them to be engaged going forward. If in fact they cannot be engaged full time going forward, then you'd probably want to adjust for that. And then you might also think about how the role will change over time as the company matures. So you might have someone who's a critical technical person at the outset, but they're a single developer or a single contributor, and they may want to remain in that engineering role, and not evolve into a CTO or a head of engineering type role um, where they might be rightfully entitled to a larger chunk of equity. So just keep that in mind. And then we have actually on our website, go to launch.wilmerhale.com. We have a pretty useful equity calculator that you can use that basically takes into account, what is the role? Are they working full time, part time? Are they inventing? Are they more business contacts? Taking all that into account, it'll make recommendations, and so we often steer our clients in that direction. Okay, so there's a question in the chat about what happens when a co-founder leaves partway through. I'll get to that in a few minutes because that's an important issue, and frankly could be the most important issue for early stage companies. Okay, so let's talk real quickly about sort of what are the typical terms of founder agreements, and then we're going to dive deep on vesting. That's going to be a critical way to keep people motivated. So your typical founder agreements are going to have vesting terms. They might have acceleration terms. They might have they almost always have what's called a company right of first refusal, which means that if a founder wants to sell their shares to a third party, the company has the right to purchase the stock on the same terms as others. So in other words, it's really critical not to have, you don't want what's called dead equity on the cap table, meaning equity from former employees or investors who've walked away. You also want to be able to control who is on your cap table, and so the right of first refusal is an important element of that. Most founder agreements have what's called a lockup, meaning that if there's an initial public offering, company shares, founders cannot sell their shares for 180 days. It's standard non-negotiable, but some folks are a little frustrated by that concept. Just know that it's we're not trying to pull a fast one. It's in every agreement. And then sometimes you have, I would call them sort of voting or governance agreements as between the founders. More often these are going to be put into place at the time you do your first equity round. But you may, for various reasons, have a reason for all the founders to want to agree on who the directors are, or agree that they're gonna always vote their stock toward a certain goal, or they're not gonna vote their shares in a certain way. So that those voting provisions are critical at the time you do a financing, but can be a tool that you can use to align expectations as among the founders before a financing round. And then the last piece, which I'll mention, you're not going to see this until you're financing, but it's called a drag along, which basically says that that if there's an acquisition offer made by a buyer that is interesting, and that the board approves, and a certain set of stockholders approve, that everyone else will go along with that as well and vote in favor of that deal. So that's one way to sort of manage the smaller equity holders to make sure that they're voting in favor of an acquisition that the board likes. Okay, so let's dive deep on vesting. So the concept of vesting is that you want to keep everyone sort of incentivized to be at the company for the long term. And so what the vesting says is that the company has the right to repurchase unvested shares of founder stock at the original, which is usually a nominal purchase price. So what this means in practice is, if you stick around for the vesting period, then you keep your shares. If you leave before the vesting period ends, then the company will buy back those shares from the departing founder. As I said, the goal here is to make sure that everyone's aligned and interested in staying with the company over the long term. And the worry is that you don't want someone to get all their shares on day one. Maybe they contributed some good ideas, but if they walk away on day two, they get all the economic benefits of having worked at the company for 3-4 years without having to go through all the hard work of actually doing it. And I would say from an investor perspective, they're frankly going to expect that that you're going to have founder terms, vesting terms in the documents. And if you don't put founder vesting terms in place, your investors are going to demand them, and they're going to ask for vesting terms that are worse for the founders and better for the investor. So just keep that in mind. Again, feel free to shoot any questions in the Q&A box as we go, because this stuff is complicated. So what's the standard vesting schedule? Standard vesting, we go with what's called 4-year vesting with a 1-year cliff. So that means 25% of your shares vest after 1 year, and then 3 years, and then over the course of the remaining 3 years, the remainder of the shares will vest in equal monthly installments. You could also take out the cliff. That's something we see sometimes. So for example, you might have a situation where founders have been working together. They might have been grad students for 1 or 2, 3 years developing something at a university. So when they come out, they may well have already put a significant amount of work into the proof of concept or the technology. And so you might say, well, we're not going to put a cliff in place because that's just too much to put into place, given that they've already put in a fair amount of work into the business. So you could vest up front a little bit to reward the initial efforts, and then sometimes we use milestones instead, or we might well have, if it's a contractor who's intended to only work for 3 months, you might only have them vest over 3 months or something like that, and that sort of incentivizes them for the short term, but allows them to walk away with all their shares after after they serve out that shorter period. Now, so to answer the question from Gabe real squarely. So again, the question was, what kind of path forward do you suggest to a company whose co-founder leaves the company halfway through their vesting period? And what are the best practices for dealing with debt equity? So if the co-founder leaves halfway through the vesting period, and they have shares, and the company has a repurchase right, I would have the company repurchase those unvested shares. That's frankly the fair and equitable situation. If you don't have a repurchase right, then you really have to dig into the details, and it's not a clean path forward. And so there's a lot of work that can go in there. Okay, so now let's talk about acceleration. So there are certain situations where somebody may not have fully vested in their shares. However, we may feel like the fair outcome for them is when they leave the company, is that they will get additional credit for unvested shares, because their contributions were so great, or because they want some protection that they're not going to be terminated by the company, in a way that takes away their shares unfairly. So there are two flavors. So acceleration basically says if an event happens, you get some percentage of the unvested shares that remain. And there are two flavors. Single trigger says that you get acceleration if there's a change of control, or if the founder is terminated without cause or good reason. I would say the single trigger vesting is less common. We don't recommend it at the early stages because it really creates sort of a misalignment, which is, somebody may say, if there's a dispute as among the founders, one founder may well just say, look, I'm upset, I'm frustrated, I don't want to work here anymore, but you're going to have to fire me to get me to leave. And so it sort of creates a toxic situation, and so for that reason, we try to avoid it if at all possible. The other thing is that if it's, let's say there's a sale on the horizon, and it's an important person, to the business who needs to stay after the sale, you don't want that person holding up the sale because they want a better deal, and they have, single trigger acceleration. So where we usually see it is, an advisor who is trying to get the company to an exit, who's not going to stick around. So maybe a short term, like an interim CFO, or a part-time CFO, they'll often get single trigger because they're going to be the first person fired after an exit. So we just want to make sure that they, upon a change of control, they get all their shares, and they walk away with, the benefits that they negotiated. So the second flavor, which is more common for founders, is what's called double trigger acceleration, and double trigger acceleration means that the vesting accelerates upon both a change of control and a call it a bad termination, meaning a termination by the company other than for cause or by the founder for good reason. So that's more common, and I would say more often than not, our founder agreements do contain double trigger acceleration, because we want, the founders will want some protection that they're not going to be terminated and lose their vesting. So I'm going to take a sideline here into sort of a weird tax issue. When founders buy their shares, they're often going to be buying their shares at effectively a nominal price. So they may be getting, 2 million shares and paying $20 or $200 for all of those shares. If you have vesting on the shares, then the way the tax rules work, by default, when the shares vest at each month or upon the cliff, then the founder may have a tax liability for the difference between the fair market value of the shares at the time of vesting and the price that the founder paid for the shares. So the tax rules have what's called an 83B election, which basically says you get to recognize all that up front, and so that there's no ongoing tax obligation to be paid. The really critical thing, actually, I guess two critical things. One, you need to make the election within 30 days of the board approval. So what that means is you need to act quickly, and it's not something that you can do sort of midway through a financing. It's not something you can postpone. And then for some founders, they may have different tax situations. So I would say it's not a universal 100% of the time you file an 83B election, but I would say most of the time you're gonna want to file an 83B election. So we always advise that folks talk to their tax advisors. So I'll talk real quickly on this slide about sort of founder stock alternative approaches. So a lot of times founders will say, well, look, I got treated poorly at my last company because I couldn't do X, Y, or Z, or somebody outvoted me, or I was not paying myself, and so there was no way to see any economic return until 5, 6, 7 years down the line. So we have a few tools in the toolkit. There are ways we can set up control for the founders. For example, you could have super voting stock or dual class voting stock that effectively says that the early folks or the founders only may have a disproportionate amount of the shareholder voting control, which means that if there's something that's put to a vote of the shareholders, like an acquisition or a critical transaction, then the founders will effectively control the vote. I would say we talk a lot about it, but unless you are the hottest company in the valley, I don't often advise folks to go down this path, because it's both complicated, but it's also investors don't like it. They don't like situations where they don't have some level of control of the company. And then the other component you can use, a lot of companies are taking a long time to go public or to reach an exit. And so, at a practical level, people need to get paid. And in the Bay Area, it's very expensive, and you may well want to buy a house. And so we have some liquidity-based solutions like Series FF preferred stock, which basically say that if a founder reaches a financing point, they might be able to sell some of their shares and exit at a higher price. That allows them to get a little bit of financial return and stay engaged for the long term is sort of the intent. I would say again that's not as popular as we initially thought it would be, but it's still an option if that's a key consideration for a founder. So to recap on founder equity, what I would say is the key thing you should keep in mind as you think about structuring and setting up your initial equity grants is you really want to make sure that the cap table that you have and the founder equity that you have sort of is consistent with what investors might expect, and if it's not, that can be a huge problem. And in particular, if you don't have vesting on the shares held by the founders and other employees, then I've seen plenty of investors say, I'm going to walk away. I don't want to invest in a company where the founders are not engaged for the long term. So just keep that in mind. So other key tips, make sure you're really thinking about each founder's role, compensating them appropriately for the needs of the business. You want to do all this early because that preempts disputes down the road. And then you don't want sort of non-active founders holding shares because it's frankly really hard to deal with sort of debt equity on the cap table without doing a lot of work. Plan in advance for new hires. You set up an option pool. You're always going to want at each financing round, you're going to want to set up an option pool and reserve shares for that. So you should always sort of have an eye toward what are the hires you need to make in the next 12 to 18 months so that you can get to where you need to be. Keep it simple. I would say, so this is sort of in line with matching expectations. Don't try and rejigger the vesting or the right of first refusal type stuff. It's standard and through the years I've had some founders who sort of tried to rethink some of these things, and at the end of the day, they always end up back in the same place, which is 4-year vesting with 1-year cliff, with a little bit of adjustment here and there. And then the last piece to sort of segue over to financing considerations is you want to anticipate the dilution you're going to see in future rounds. So I haven't talked a lot about dilution, but effectively the founders are going to have a fixed number of shares, and then you're going to issue more shares at each financing round. So what that means is that the founders' percentage ownership of the enterprise is going to go down over time. What we also say is, while your slice of the company is smaller, the pie, the company, is growing bigger. So in the end, the dilution is sort of neither positive nor negative in the abstract, because it's in the normal case, it's going to imply that your company is growing and sort of getting to the next stage in its growth. And fundamentally, you should think about future financing rounds as what is necessary to sort of take the company to get to the next level. So do you need money so you can do marketing? Do you need to hire so that you can scale up your technology? Do you need to make capital expenditures so you can put out a production line or facility? Do you need credibility so that you can do partnership deals with large strategic players? So all of those considerations come into play as we think about getting to your financing round. And so just keep in mind, what's the purpose, and what dilution am I willing to take on to get to the end goal? And it may be a combination of all those factors. All right, so I'm going to pause for questions. Feel free to keep putting questions into the Q&A box if you have any. And then if there aren't any questions, we can segue on to talking about planning for a seed financing.
We have a couple of questions here, so I think this is a good moment to go over some of them. So we have the first one is, we started our business with the everyone the same to keep simple approach, which is a bad approach. So one of the founders isn't in the business full time. Any advice on how to redistribute equity or fix a situation like that?
Yeah, so it's always going to be dependent on how the stakeholders internally are aligned for it. I mean, I guess in the abstract, what we often will do is rather than having founder C pay shares over to founders B and A, what we would do is issue more shares to founders A and B, and that may be in the form of additional shares of founder equity, or that may be in the form of an option. But it really just depends on the life where they are in the life cycle.
Got it. Thank you. What happens if a founder's stocks are distributed and then a couple years out, the team realizes either an individual is overperforming or underperforming, and their shares need to be adjusted to account for their contribution? How does that work? Is it common to keep someone on the team to increase their shares or reduce their shares? It's kind of a similar question.
Yeah, similar question, and so what I would say is it really goes. I mean, so both of these questions go to why we spend a lot of time telling folks you really need to think about things on the front end, because it's very hard to reallocate. And so again, think hard about it at the start. If you have underperformers, in all candor, a lot of folks will just, if they're underperforming, the companies will let those folks go before they get to their cliff, to ensure that there's no debt equity on the cap table, and that's sort of the purpose of the cliff. Yeah. If they pass the cliff, there's really not a lot you can do other than let them go. On the flip side, overperformers, you can always give them more shares. You do need to, as you have investors, you have to sort of manage that with your investors and be careful that you're not sort of overplaying your hand, because that creates additional dilution on everyone, and you take it too far, and your board's gonna feel like you're overcompensating folks.
Okay. Do you think we have time for a couple more?
Let me fly through the seed financing slides, and then we can do a couple more.
Sounds great.
Because what I really wanted, I mean, so my objective in talking about seed financings, frankly, is to just talk about continuing the theme of keeping it simple and trying to go with established paths. 3 structures you can use. There's an equity financing round where investors pay money to buy shares. That creates dilution. There's a convertible note, which is essentially a debt instrument, where the debt instrument basically says that if the company is, at a maturity date, the company will repay the debt. And if the company has financing in the meantime, the note will convert into the next financing round. And then there's a SAFE, which is kind of like a note, except it doesn't have a repayment feature. So to get to the punchline, what I would say is at the earliest stages, most clients choose to go the SAFE or the note route. And I'll fly through my slides to just sort of give you a flavor of why. And then we can get back to Q&A. So on an equity financing, what I would say is there are lots of considerations and lots of deal terms you need to think about. They boil down to sort of 4 or so primary issues. Influence on the company's founders and its employees, control over the exit, ownership and economics, and then incentives. The key thing in an equity financing round is you need to quote unquote set a valuation, which means that somebody's buying shares and they're paying a price for those shares, and so the valuation becomes super important. And at the earliest stages, it's frankly super complicated to fix a valuation. But sort of the chart at the bottom goes to what the issue is, which is, the valuation. You take the valuation, you divide by the shares, that gets to your pricing. Your pricing is going to drive the number of shares that your new investors are getting. And then the number of shares that your new investors get drives dilution to founders. You want to avoid that dilution without really thinking hard about it. And so that's the primary reason we try and avoid equity rounds at the earliest stages is, once you fix a valuation, you're on a path toward dilution. And then there's other wrinkles. So these are control rights. These are additional economic terms: liquidation preference, anti-dilution, dividends. These are some control rights that you'll need to negotiate. And so all of that boils down to, there's a lot to think about, and for that reason, we go toward the note or the safe path. So the convertible note, I think, is the traditional path. It has sort of debt and equity like features. Somebody's going to pay a fixed amount. They expect repayment on a maturity date. Be interest paid on the principal, and if the company is then get distributed at the time liquidated. So there's downside protection. What I would say is the difference between a note and a safe is that while the safe has a fixed principal amount, it doesn't have an expectation of repayment. It does not have an interest rate, and it sits at a lower priority. So there's less downside protection. So by and large, the safe is better for founders. And then, so to get back to the equity components on a convertible note, as I said, the principal amount and the accrued interest can be converted at the financing round. Usually, we try and make it automatic on what's called a qualified financing. That way, the investors don't have any leverage to hold up a financing that meets certain criteria. And then, the other thing I would say gets negotiated, a fair amount, is a cap on the conversion value, so that the investors have some protection, so that if the company's valuation goes up between the time that the seed investor invests and the first equity round happens, there is some protection there. The bottom line is this postpones the need to set a valuation, and so it postpones a little bit of that dilution, that need to really stare hard at the dilution until later on, for better or worse. I talked a little bit about the safe, so similar sort of widely used in the industry instrument, no maturity date, no interest, and it doesn't have debt holder protections. What I would say is, it has a lot of the advantages of a note. I would say the one thing I see more often than I like is it's so simple that founders like to go out and do these raise on these instruments, and sometimes they can get themselves into a place where they raise a whole lot of money with a low cap on conversion, and that creates, frankly, a lot of dilution that they were not expecting to see. Here's a summary table. So with that, I'll wrap up, and then we can go back to Q&A. And if you have any questions, do feel free to reach out, or you can visit our website, launch.wilmerhale.com. And with that, I'll turn it back over to Gabriella for questions.
Thank you very much. That was super interesting. I think that helps a lot of our startups. We have a couple more questions here. What is a fair options compensations for a non-founder teammate who have a C-level position? Lead a scientist who joined a team, for example, early on, and later promoted to CTO, plus have a competitive salary already.
Yeah, so I would say it's really, really fact dependent. And so I can't, in the abstract answer that question. What I would say is, the way I think about it is there's sort of a tier of founders who are generally not fairly compensated from a cash perspective. So for that reason, their equity component is outsized. So I would probably recommend them, this person who's acting in the CTO capacity, but still being fairly compensated. I would probably put them in a lower tier from an equity perspective, considering that they are being paid a fair amount in cash. Whether that's 2% or 10% really depends on the company and its stage of the life cycle and all the various other considerations.
Thank you. How do you allocate equity options, if any, to a major contributor or an investor who is not going to be joining the new company?
So investors, the way I see it, investors, they, it should be the case. There's a lot of money flying around, even now in the midst of a pandemic. There's a lot of capital flying around, and so it's just necessarily part of the job of being an investor that you should make introductions. You should be thinking about how you can help the company, and so I don't view an investor in the abstract as having any right to compensation outside of whatever return they get on their investment. You could make an exception down the line when the company is about to go public. Maybe that changes, but early stages, you just don't compensate those folks. For advisors, that's sort of the other bucket of folks who are sort of non-everyday contributors, but still may provide advice and guidance on an ongoing basis. I sort of say 1 to 2%, and then it goes on a sliding scale up or down from there. And it really depends on what they're bringing to bear. And you would put them on a vesting schedule. Typically, it's a 2 to 3 year monthly vesting schedule with no cliff.
Could you give an example of how Class A and B common stock works?
Sure. Yeah. So the classic example is the way Google or Facebook shares work. They basically say that a founder, a Class A holder, may have 10 votes per share, whereas Class B may have 1 vote per share. So you just have more voting rights. And then you're only issuing Class A at the earliest stage, and then the Class B gets issued as the company matures. So that's the classic case. You might also build in, special control rights for the Class A holders or the Class B holders. For example, you don't do an acquisition unless you get a vote of a majority of the class holders. So that's the type of flexibility that enables you to get into.
Perfect. One last question. What are some of the considerations with going straight or very quickly to a venture capital level funding rather than seed level funding on the way to a VC level?
So I think it's really sort of matching the investor to the company's life cycle. So why would you? So let's say in an ideal case you would raise a ton of money, and the traditional path has always been go to the venture funds and raise that money as soon as possible. after granting the founder shares. I still think that's reasonable to do. The argument goes that, number one, you're gonna, no matter what in a fundraising cycle, you're gonna have a ton of conversations and a ton of projections, and so you improve your odds by sort of meeting folks who are a little more accustomed to investing at the earliest stages. So, a venture investor usually does bigger deals, and they're expecting a bigger return, and so they may not have sort of the the interest in your stage of company, and so you may be wasting your time, frankly. The other thing I would say is sort of going along with that. I like to think that investors are going to provide, sort of value added, and if an investor is investing, they have a smaller pool to invest from and fewer companies that they invest with, you're just going to get a little more of their time, and it may well be helpful to get their sort of value add at the early stages to make introductions, or think about commercial considerations, or technology development.
Good. And the last one, I think we have time for one more. How much percentage should be given to broker type VC company?
To what type of VC companies?
Broker type. A broker type.
A broker.
Yeah.
I would say you almost certainly should not be engaging with brokers at the early stage. So if you're I would call it at a Series C or later stage, then maybe you engage a broker or a finder to help raise a large financing round. And it really depends on, are they a top tier investment bank that's going to charge a ton of money? They may have a fixed percentage that they're going to charge, as opposed to smaller brokers who are in the marketplace. There's a lot to evaluate when you think about engaging finders or brokers. So I would say talk to your lawyer.
Okay, with that, I think we are ready to wrap up. I really appreciate it, and I'm already receiving really good feedback from the startups. So I think this is a very popular topic. So I really appreciate you joining us today and the effort for this great presentation.
All right. Well, thanks everyone. It's been a pleasure, and feel free to reach out if you have questions.
Yes, Eric's also a mentor for Plug and Play. So in case you are interested in a mentor session, feel free to reach out. Thank you, everyone. Thank you.
All right. Thank you.